Oh, g'day. How you going? It's Sultan here. Welcome to Inside Commercial Property with Rethink Investing. Highlight of my month, talking about commercial property. I am a commercial property investor. I'm thinking more about commercial property investment as the days go by. I've been pretty vocal in a lot of commentary around commercial and just investing in generally over the last period of time as Australia's grappled with all these forces, which much of it out of its control. Inflation, pandemics, rising rates, all these type of issues is really shaping and framing the way in which people are investing in property. And commercial property was the darling of investors probably a year or so ago, and maybe less so now, as those commercial investors which are leveraged have worked out that they're not getting as much money back every single month when they reconcile their P&Ls. But that said, commercial property is still performing pretty well, irrespective of how you normally get into it. You're just going to make the right calls. Some markets are better than others. Some asset classes are better than others. We like to cover that on this particular podcast. And fortunately, you haven't got a chancer like me muddling their way through this podcast. I know a little bit about podcasting. I don't know a lot about commercial investing, but my co-host, Scott O'Neill, who's the managing director of Rethink Investing, knows a lot more than I do. He joins me in the studio. Scott, how you going? Well,
G'day, Phil. Yeah, good, mate. Yourself?
I am pretty good. Just looking at your email signature, and it's big and it's bold, and I guess it goes with your growing business. How, mate? I'm seeing you in the papers and stuff, and you're all over the joint. This business is booming. What, you must be doing something right. What's happening?
Yeah, look, it's every sort of month it sort of just creeps forward a little bit. So it's not there's no sort of giant jolt ahead, but yeah, the momentum's really good. The business is growing. The product, commercial property, it is getting more mainstream focus, and we are collecting and benefiting from that, no doubt. And like you said, like things like the interest rates and that, it's not as good for the returns for our investors, but it is a relatively short-term problem, and the investors are quite sophisticated in this space. Like, you're not going to be buying, an expensive commercial property if you're fragile to the point where the next 6 months will make or break you. So they are investing for the long term, and yet, look, our volumes are up. Like, as we speak in this August month, like we've sort of got about 80 million under contract this month, which is well up from our average about 50 mil. So the volumes are very large, and yeah, we've got to build a business around that to support it. So we've been putting a really big effort in hiring people on the ground, so local connections in markets. Like, we've got a guy in Tasmania now. We're looking into we've got Melbourne. We've got multiple people down there. We've got someone in Perth now, half a dozen up in Brisbane. So there's about sort of 50 odd of us around the country now, and yeah, we're just working on getting more detailed with due diligence. And yeah, just look, the real trick is getting access to stock, and that's what we're the best at in this country. Like, we get good volumes coming through, and we have to reject huge amounts of dud properties, but but that's the trick. If you've got a good product and you can avoid the bad ones, that's really the basis of growth, I feel.
Yeah, and that's the secret, right? It's was it the John West rejecting those good fish with the Chinook salmons? I'm sure it's a good fish for someone else, but not for Rethink Investing clients. But the point you make is, and to my earlier comments, commercial investing, it's been around for eons. Residential gets most of the focus and the bandwidth, but our conversations over many years now is that most sophisticated resi investors always end up becoming commercial investors, and probably sit there and think, why didn't they do that sooner than what they did? And I absolutely fall into that bucket. When I look at my portfolio, the commercial stuff's still positive, irrespective of all the interest rates that's been happening. Whereas I'd have to look hard to find a positively geared property these days in my portfolio. So that's just really the market we operate within. But the question I've got is there more commercial investors in the market today than what there were a couple of years ago? So is the pool of investors getting bigger, but the pie is essentially staying the same size, and therein lies, opportunities and threats to organizations like yours, right? Because you've got more people wanting good properties, but to your point, you sort of got to say no to a lot of dud assets. It's making your life hard, mate. You do a podcast like this telling all the benefits of commercial property, and then you set yourself up for headaches.
Yeah, look, and it's a great point. Like, there is, without a doubt, more demand than there ever has been. Like, we are a stock driven, we've said it many times, we're stock dependent. That's our limiting factor in growth and revenue for a business. Like, we've got clients, but there's not enough good properties. And one of the criticisms we get from clients is our waiting periods, particularly in the more affordable price points. Like, we've had to close our doors multiple times over the years for up to 3-4 month stints at a time, just not letting clients in, because we'll only disappoint them with waiting periods. Like, it's not as bad now, but like, for a good sub $1 million property, you can wait 6 months, sometimes longer, and it doesn't mean they're not out there. And it's like, I'd probably look over 200 sub $1 million properties a month, and out of that we might buy a handful of them for clients. Like, there's a lot of garbage out there, and we're not going to sacrifice on yields like, say, some of our competitors will. They'll go and buy stuff into the low 5%, and I'm just like, well, that's not solving the problem the client initially sold or signed up for. So we'd rather create a waiting list. Like you said, the John West analogy is one we sort of use. Like, it's better to have better quality and someone wait a bit longer, especially in a market like this, because it's moving sideways. There's not rapid growth like there was 12 months ago. Some markets are declining. It's a good time to take your time and just wait for that right property. The guys that have larger budgets, you're going to get the best deals you've seen in 2-3 years, because interest rates have caused better buying conditions at that range, and the competition is a little bit thinner, but there is slightly more stock on that market. And that stock will change. Once interest rates eventually start coming down, the power dynamic will go back to the sellers quickly, and then the best buying days are behind us. So we've got a period before that happens, which is great from a client and business perspective. But yeah, we're seeing yields hold their range. The demand is really propping prices up, and it will continue to do so. There's some sectors of the market which will hurt more than others. Like you're probably your fund manager level in the office space is the famous one. It's in the AFR every week at the moment, where there's 20% plus price falls. But good quality industrials holding its value. Good quality retail, same deal, and medical and all that. It's the growth prospects are strong, so people are paying premiums still. And as we get closer to the eventual interest rate drop, people will then start pricing that in, and prices will go up.
Well, you make a good point. It's a good time to take your time, and I reckon it's pretty sage. A lot of property investors in too much of a rush sometimes. So I call it strategic patience, right? Is just, if you do the right stuff and then just wait, typically the right outcome will appear at the right time. I think too many people try and orchestrate or accelerate that unnecessarily, and therefore don't get the outcome that they want. But we haven't done it for a little while, Scott. We've been sort of quite down in tactical type level stuff recently. Just to get a bit of a market update from you, because we're probably at or very, very close to the terminal interest rate. It might go up a little bit. We've got a rate announcement happening shortly. And depending who you talk to, some banks are now saying it's at the top. Some are still pricing in 2 more 25 basis point rises, which will have impact on commercial lending. And that's just reality of it. But, I think the mail is that rates will start dropping again at the back end of 2024. And we've seen employment levels, so unemployment rate is starting to go up, which is what they've wanted, to try and calibrate more of some more equilibrium in the economy. Inflation is already starting to come back, so things are starting to normalize. So I think it's going to get to some time before we get to the target band of 2 to 3%. However, things are moving in the right direction, so I think everyone would benefit from recalibrating their attitude towards commercial property. If you had to define, with a view of a state of the market, and we'll talk about that for a little while, Scott, but then I just really want to just drill down with you and a bit of a reminder, bit 101 for those people who've been tuning in for some time. It's nice to to refresh, where you can tactically really start creating value in your portfolio, and where can you get that equity uplift? How can you create equity and do that really well? And some of those common strategies for just getting every drop out of your portfolio that you can do that often you might not be doing. But let's start at the state of the market. Scott, are you happy with where things are? Or you got any major concerns? Are you lying awake in bed at night, sort of worried that you're going to blow all your dough personally, and you're pretty much the custodian of the decision making for many of your clients? It's a big responsibility.
Yeah, great question. Look, I'm notoriously calm and collected with all this type of stuff, and this market is a perfect example of what you should be as well. Like, I'll give you some stats. So the latest JLL reports have come out, sort of, showing all the baseline net yields around the country. Because there's all this talk, like you look at the media and someone who doesn't know commercial property, they go, oh, the vacancies, they're always at every corner. And then what's the other myth? Like Amazon's here, all retail's dead, like all that kind of stuff. They throw those, those blanket comments out. But the reality is, on the ground, things are very steady and quite strong. And to back that up, like if you look at the national weighted average yield for retail, it's expanded from 5.57 to 5.7. About a year and a half ago, it was in the low fives. So that's not a big yield decompression. Rents have been increasing in that time. They've been steady in the last quarter, but by and large, retail is holding its value, and rents are basically moving sideways. They are declining in CBD markets. So, it's important to distinguish the different types of retail. Big box retail is having the best rental growth. Neighborhood shopping centers, probably second to that. And then you've got your strip mall and those kind of more individual stuff suffering a little bit because their proximity to cities and stuff like that. But by and large, they've done well outside of COVID. Retail spending's up 9% in the quarter too. So, all this inflation has created better profit margins for a lot of businesses as well. Like, anecdotally, over in Europe as well, they've all increased their prices on every single type of asset over here. And it's not because their costs have gone up in most cases. It's because it's a good excuse to raise your prices. So, everything from car washes to cocktail prices, everything's gone up like, 20, 30% over here because they're all copying each other, and it's people, the customers accept it. And that's kind of creating this self-fulfilling prophecy of, inflation. And retail is benefiting from an increased profit margin. And that's not bad for the long term, but steady as she goes in retail's the summary there. Office is the famous one where they've got book valuations at the higher level well under the current prices due to lack of sales. There's a long-term problem there. We all know it. The value of office space, it's not going to be worth as much as it once was. But interestingly, the average yield in the country, this is every capital city, is 5.83%. But the figure which kills this is there's a 14.4% headline vacancy rate. Despite that, rents grew 1.1% in the last quarter. So you can see they're kind of kicking the can up the road there. That vacancy rate should be probably, it's got to be under 10% for the office market. And there's supply coming on. The secondary stock in that market will struggle to sell. There's going to be a point where it'll devalue enough to become in line with residential prices, and they'll gut the thing out and turn them into, basically apartments. But office is worth more per square meter than an apartment. So there's a moment in time that's going to have to, there won't be transactions until the residential guys see value, or they'll just refurb the property and make it more of an A-grade offering, and then people will occupy it. So the fund managers are going to have to make lots of difficult and costly decisions in that space. So that's a moving target there. But industrial expanded their average yield from 4.8%. So you may notice that's the lowest yield in the country due to the strength, and now it's 5.08. So yields are still very tight in industrial, and the real key figure here is in the last 12 months, rents have grown nationally 22.8%. So that's enormous. And the reason this is not going to slow up is there's genuine issues with supply. The demand is still there. It's not going to slow down for years because councils are basically not releasing enough industrial land. These planning risks are flowing down into the developed level where they can't stack up feasibility studies for a lot of these upcoming industrial projects. So especially in kind of inner city areas, no one's going to release large plots of industrial land without there being pushed back, or it's already industrial, so there's going to be that's a sort of long-term problem, I feel, in this country. We don't have enough industrial land, and good quality, well-located industrial land. It's going to attract that rental growth for the medium term. And the only thing that'll slow that down is if they release a lot more property, and maybe the economy takes a big hit at the same time. It'll take a lot to shake that market. But yields are lower, so you've got to cop that on the way in.
Yeah, industrial as a a subclass asset sector within commercial property. I think we've been chatting about it ever since the pandemic. We kicked this podcast off during the pandemic, and we've been very bullish on industrial assets, and we continue to be. You're seeing on these sort of arterial feeder roads in and out of major capital cities, they're rezoning and releasing a lot of industrial land, and I think that's going to be a big driver. And even though there is still, within the city areas, it's pretty hard to get stuff rezoned in industrial. So it's moving out to the fringes that remain strong. But I got to call, sometimes these numbers, and you got to be careful with it. Maybe your view on it as well, Scott. I eye these numbers with a certain degree of suspicion, and maybe that's just because I'm just inherently just a journalist who doesn't really believe always what I hear. But when I think of sort of the office market, it's so easy to manipulate the numbers in commercial property, and having been on both sides of commercial lease negotiations, claiming I think you said a 1% rise in rents in the office market, like that's at the headline rate, but there are so many fancy, funny, little things in the background, little side deeds and whatnot around incentives and et cetera, where you never actually get a real picture of what the net sort of square meter rate is, because it's never really, they're not connected in with the lease. They're always sort of adjacent to. And this is why I put a big question mark over a lot of these numbers, because I just go, that might be the case on a face rent value, but once you get into the nitty gritty of pulling apart incentives, of which are huge at the moment, I don't know what you're hearing, but huge in the office markets, those numbers just I don't think are going to stand up. Is that just me just being an idiot and not really understanding it?
You're 100% right. So incentives are elevated right now in the office market, which is sort of why I made that comment. They're kicking the can up the road a little bit in that market. So the vacancy rate, the higher that gets, the more you've got to offer incentives. So, it might be a 10%, 15% incentive in industrial. It could be 30, 40% of the lease as an incentive. So, and that's for office. And retail is pretty tight as well. Like it's nowhere near office. Like it's more to do with fit outs and stuff like that. It's a little bit more case by case with that example because the variations are so great. But office is going to be affected by larger incentives, and effectively what that does is it knocks off purchase pricing power. Like when you sell a property, they'll generally pay out an incentive. That's standard practice. So if you're buying a $10 million property, there might be an outstanding incentive of 500 grand. They've got to pay it out to you as cash at settlement. So they've kind of lost it off their purchase price, but it's fed into the system to create a face rent. And yes, that's how they come to those numbers. So it's funny accounting. It's been done since the dawn of time. I don't like incentives, but I see him working on small examples where you can push rents up and get longer leases. But when the whole asset or whole industry is backed by it, then it just spells more risk.
You can't change. You might not like the game. You can try and start a new game, but if you want to operate in that office environment, and on that basis also, if you buy like a strata, or if you buy a building with multiple tenancies in it, you need to pay out the remaining incentive to the tenant as well, because if they're breaking lease and stuff, you've got to be compensated for it. it's
Yep.
pricey business. And if you've got multiple tenancies in a building, you've got to really plan your exits pretty smartly in order to get it right. So, that's just a big buyer beware to anyone who's operating in that space.
Yeah, exactly. And all the more reason you've got to be up to speed with commercial property. There's just a lot more moving parts, and it's the reason we don't come across as many people in this space. It is complicated. You've got to understand the laws. You've got to be, you've got to be really drilled in or dialed in rather into the economy as well, because you've got to, it's not just worrying about vacancy rates or, where the next infrastructure project is for people to live. It's the whole economy as a general. And yeah, if you get it wrong, the risks are higher. That's why the returns are higher.
Yeah, and that's what you want to be chasing, but you want to do it with through the lens of sensibility. And people do get it wrong in this space. So, but people do a lot of Hail Marys and they do pretty well in commercial. But you must have seen a lot of people blow their dough, right?
Yeah, look, I mentioned in the previous podcast, the way I see most people blow their dough, which isn't happening as much now, is they don't know how to price a commercial investment. They'll see a KFC, fall in love with it, and buy it at a 2-3% yield. Like they're effectively paying, in my opinion, double what it's really worth. So, if you're buying a $4 million asset, a $3 million asset for $6 million, that's pretty silly. There's a lot of people that don't care about losing money, and this is the context you've got to throw into this market. This is where people with endless amounts of money come to as well, like the family offices, the people that they don't know what to do with their money. They'll just plonk it into a $5 million asset. Like that doesn't happen in your blue collar houses because everyone's sensitive to the interest rates. Everyone's kind of maxed out their deposit to leverage as much as they can because that's the strategy. Commercial, it's not so much that. This is where you basically drop large sums of money. Obviously the people getting to that high net worth status will follow the same rules as residential, leverage as much as you can, go for the best return you can. Like that's how we want to invest and how we invest at Rethink. But there is another spectrum of buyers out there that don't care for that. They just want to park money up and don't want to think about it for 30 years and pass it to their kids. We don't compete with those. We would love them as clients because we could get a much better returns, but it's a space that it surprises how many of these guys are out there. And
scratch the surface, and there's plenty of rich families around, and these are sort of generational wealth that just keeps recycled down and through, and for those of you that know, family offices just it's where investments are pooled, and they have someone that typically makes those investment decisions for them. But most family offices sit inside of more traditional investment houses, right, which aren't really property orientated, and you don't always get the strength of people that really know what they're doing with commercial property. Sometimes, and I'm generalizing, sometimes in some of these family offices, they're very comfortable operating in around equities and bonds and some of those other financial instruments, but they often overlook property. So putting in cash into commercial property, which is silly money, you probably get a much better return. Maybe they should be using buyer's agents, mate. Did you ever get calls from family offices saying, "Well, this is outside of our skill set"? Can you do this? Can you do the commercial property bit for us?
Oh yeah, we work with family offices quite often. It's probably one of our growth markets of the last 2 years. So fair few South Africans at the moment, Singaporeans, a few from Korea, Japan. So it's those kind of low yielding or higher risk countries that are now seeing Australia as a really good place to invest. We are globally recognized as a safe haven, and our yields are good compared to the safety it offers. So that will attract institutional money long term. Particularly from the Asian countries, because we just offer better returns. And you look at what's happening in, say, China, and the risk that market has in terms of like the economy with their housing market at the moment. There's going to be more money flow out very quickly if they can get it out in time, and Australia will collect a lot of that. South Africa's a market where it's got risk, as you could imagine. Like it's just unstable compared to Australia. It's not as stable, and the growth is not as banked in. So. There's a number of those guys coming over. So yeah, watch this space. The foreign money will keep coming, and
Yeah.
commercial
Well, that's the right
is.
question then about saying a family offices that's to actually have a focused discipline that is commercial investment. And this being a market update or state of the market, and you spoke through those different asset classes by way of industrial and retail and the office market, but there's a lot more to the market than just those performance of those things. There's all the macro and microeconomic factors facing it. We spoke about interest rates, etc. The global forces shaping the Australian property market, commercial market. Any major concerns there? Noting that Australia and its spot in the world, particularly within within Asia, we're an Asian nation. It should be still flight to the safety of Australian real estate. Any significant global international factors which do you think will be insurmountable headwinds for Australian commercial property?
Look, the one in the big background is always going to be if there is a war, whether it's the China-Taiwan scenario, like that will hurt if that scenario eventuates, just because it involves China, the location is close. You look back at history, what wars do, it's not good for the economy, and government will prioritize spending in certain locations, but that could be good for subsectors of the market, like the likes of, say, Townsville we spoke about. If they increase defence spending up there, that's good for them. Down in South Australia, there's plenty going on down there. So yeah, I think you'll see certain markets really benefit from that section, and then others just in, I guess, the macro side of things, people will spend less because of the fear. So look, outside of those kind of black swan events, there's a good story for Australia, like the immigration side versus what they're building is I guess the ratios are off, and that will benefit property owners. They're not building enough of anything, yet they're letting a lot of people in. So politically that'll cause pressure to whoever's in power. But yeah, you've got to build more to support the staff or the amount of people coming to this country. And that's that'll wash through more strongly than, say, what the interest rate's doing this next month or two. Like there's a good medium-term benefit that'll bring to the country. And yeah, outside of a large recession, like what would trigger it? There's plenty of things that could, but by and large, the economy's going okay. It's just people are feeling the pinch. There's less free cash flow in the market. So from a commercial perspective, it is a cash flow focused asset. So people that need cash flow, there's still nowhere better to get it without taking great risk. So I think that will, it'll hold the right asset classes through this next period.
Yeah, if you asked me 4 months ago, I probably would have said that the chance of a recession was likely. I'm starting to change my opinion on that. It's softer than where I think everyone would like at the economy right now. But are we going to go that far? I'm not too sure now. Well, what's your views? Do you think the Australia will sort of spiral into a recession, or do you think it'll be averted?
I personally think it'll be averted. Unless there's some kind of new shock, but inflation's coming down. If interest rates went up another 2 or 3, that would push a lot of businesses to the brink. But because the chats out of that side of the fence are now saying we're probably at the terminal rate, I think that will mean there's no recession. But if for some reason the inflation spikes again and we have to push rates up, it'll push the lower and middle class under, and that's really not good for the economy. Like these guys that have bought their first home, that's who's getting punished, and then the renters are getting punished because everyone's pushing their costs down to the tenants. So it's creating a real social issue. These interest rates, like the rich are fine, they've got cash assets and their cash flows are fine. So it's hurting the wrong part of the economy, in my opinion. Like you want to protect those who are trying to make a thing for themselves, get ahead, and the incentives aren't really there. And especially with all the stuff with tenant reforms and stuff like that, it's really made residential investing less attractive, and that's going to make a case for not investing in residential as well, which means less rentals. There's going to be a housing crisis. There has to be.
There is already. And we're going to be really careful as a nation about what we choose to prioritise and emphasise. And when you look at that and consider that, Scott. You've got certain parts of the establishment trying to get these tenant reforms, right? But I think there is real lack of appreciation of exactly who owns all the investable investment properties in Australia. They're mum and dad investors. I think 94% of all investment properties in Australia are owned, or properties for rent are owned by mum and dad investors, inverted commas. So, structurally, we need to be, we need to have a sense of confidence that this is the right structure for us. And I can't see that changing because this is the way the government structured it, this is the way the ATO applies it, and our banking sector is built off the back of it. So we can't have our cake and eat it too. If we want to be a market-driven economy, there needs to be an acceptance that interest rates are going to go up and down, and that's been very hard for a lot of people to actually go, what, interest rates aren't always at 2%? No, can't be like that. Like, grow up. That's the way it is. And interest rates were pretty much at average levels right now, but the same acceptance needs to be having at the tenant side of things. That rent's going to go up. That's the way it is. So sensible conversations around that is absolutely imperative. But we need to make sure, to your point, that those more vulnerable parts of the Australian economy, those people who are, the heartbeat of the nation, the workforce of this nation, don't take all the heat from, the economic cycle that we're in right now. And that's a big criticism that's taking place right now. I was only sort of whinging to a mate the other day. I was expecting my power bill to go down and my rents to stay low when we went to the poll last time. That certainly hasn't been the case. This is not a political podcast by any means, but that's hurting sort of, that heartbeat of Australia. It's not the wealthy people the sophisticated wealthy people who can buttress and maneuver and do whatever. So this is the issue we're in right now. But back to commercial property. Well, we made the point when we did our first podcast, Scott, that commercial property is inherently connected in with Australian business, because Australian businesses rent commercial property. And if Australian business is faltering, that means commercial property will falter. If Australian businesses are faltering, it's usually because Australians are faltering because they don't have the dollars in their back pocket to be able to do what they were doing once upon a time, or what they want to be doing. So it's very much a cyclical thing. So, commercial property is a big part of this ecosystem. Whether or not you shouldn't be considering commercial property as an investment class right now, well, to the point you made beforehand, it's a good time. What was a good time to wait time? Or I can't remember what you said beforehand.
Yeah. Deal quality is essential. So there's still a lot of urgency for investors out there to buy, because people that have cash want to deploy it. And there is the threat of interest rates eventually. And I use the word threat. When it drops, it's a threat to prices, because prices will go up. The yield compression will begin again. We're in a yield decompressing phase. So effectively prices are dropping versus the rents. That's the best time to buy. If rents are compressing, it means more competition. You're fighting. It's just like an auction clearance rate of over 80%. That's the type of scenario.
More people out there means bad for buyers.
Correct. Yeah. And the supply is so low as well. So people that aren't, like the owners that aren't getting their prices they want, they simply hold because they can, and what else are they going to do with their money? That's sort of the scenario that comes up. So stock's low, buyers are there. But yeah, you've got to still get a good deal in this market, because you're not going to be making huge cash flow on the asset, especially if you're lending 70 to 80%, or you've refinanced your house and you're doing 100% loan, which is common. There is a need to get a higher yield, and I think you've got to stick to it. But if you are sort of lucky enough to be quite liquid with cash, it is a very good time to buy. Particularly those are sort of that plus $2 million range. You're getting a considerably better deal than you were 12 months ago. And that's why our volumes are up, because we're just getting better deals. So it's easier for clients to say yes, because the numbers stack up. But yeah, to my point, if you're waiting and your budget's 700 grand, it takes time to get that right. And that's okay. You don't need to go off and look online and then buy something and sacrifice on yield and quality and age and all that kind of stuff, because that's what people do. And then they're stuck with that asset, and it'll take you 2-3 years just to kind of recoup the losses that you incurred on paying too much. So there's benefit in waiting at different price points.
And for those people who have commercial property, whether they've been sitting on one asset for a long time or recently, or they've got a large commercial portfolio, you should always be thinking about how you can extract the maximum value from that. And I think a lot of people sort of sometimes forget. They just, commercial property in particular, I always say, people say, oh, property's a great asset class because it's passive. I go, no, it's not. If you're a residential, property investor, you're in, you're an active investor. That said, it's easy to be a passive commercial investor. There's a lot less moving parts, right? Like purely because of the way it's constructed. You don't need to be, dealing with your property manager on a daily basis for issues and problems. It's all covered, it's all sorted. You can be very passive. But if you are an active investor, you can actually extract a lot of value out of your commercial property or commercial property portfolios if you're willing to do the hard work and spend the time and the focus on it. And I know you sort of have a bit of a process, a methodology for making sure you can maximize that value. 7 steps, Scott. And I know I'm conscious of time, but I might just get you to quickly run through them, just a bit of a refresher for everyone about how do you actually extract greater value when you're building or sort of growing your commercial property portfolio.
Okay, so we've got 7 main steps to increase value, because once you bought the property, you want to see what you want to drill down into whatever asset class you've got to see how you can extract that equity. Because a big part of what I do and Rethink does is we want to sort of build portfolios. It's not just here's one property, see you later. So that's why capital growth is so important for us. It's not just the cash flow. That's just one small part. But so one example, this is the most common way of adding value. It's through rental increases. Very basic. You buy something that's kind of under rented, and you've got to be very careful with rental increases because you've got to compare like for like assets. So, one we're dealing with at the moment, it's ground floor retail office type thing. So it could be a real estate agency or whatever. If you look at the square meter rates on the surface, it may look like it's at market because all the stuff 3 to 4 floors up are paying a similar rent, but ground floor locations are a premium. If you know that, then you can, because there's just more tenants to choose from. It's got advertising benefits for the tenant. You can push the rents up significantly, like it could be 30, 40% without others seeing it. So you really got to drill down into the investment. But high level, things like industrial, like I mentioned, 22.8%, that's the average lift in prime rents across the country. So, an example, one of my clients, he had an older warehouse in Brisbane. The initial rent was 79,000, and through a stroke of a pen, he renegotiated a 3-year lease at 105,000. So that added 26,000 to the income. So how does that increase the value? Well, it's the cap rate of that market is 6%. So that 26,000 divided by 0.06 equals 434,000. And that was then taken to a valuer, extracted as equity, and we're looking for the next property. So very simple, no risk, same tenant. We offered him 3 months free rent. So, I was talking to the client throughout this process. The tenant pushed back. So this is where you got to be a bit strategic. Like every tenant is going to say the same thing. That's ridiculous, not paying it. I'm going to move. Be ready for that conversation. And we had the spreadsheet showing all the comparables, and you can't argue with that if they're, just look at the spreadsheet, go look at the properties if you want. This is what the rent is. And they'll huff and puff, and eventually they'll just meet the market. That's probably the most aggressive way of doing it. The other way I like sort of doing it is let your property manager come to your tenant earlier on in the piece and kind of act like they're acting in the tenant's favor. So they might just say, look, I haven't got approval from the owner. What if you took your lease negotiation early? I might be able to sling you some free month, a few months rent free, and that make it the tenant's idea, and then you know where they're at. And that's a really good way of kind of starting that conversation without showing you're driving it, because every owner wants a longer lease and higher rent, but you want to sound out if this tenant is keen to start with. And that brings me to point 2. Another value increase is lengthening the lease. So if you turn a 1-year lease into a 10-year lease, it's obviously going to have an impact on the value, because the perceived value to investors is a greater secured asset. So there's more income banked in. An IOU essentially is all a lease is. The tenant owes you more money. The bank will lend to you like better, so you might get an advantage on your home loan. There's a lot of benefits to a longer lease. And over the years, I've kind of compared like thousands of deals, what that actual lease does to your value. So I'm going to use real rough numbers because it has an inverse relationship to the yield. So let's use a case study. If your rent if you buy $1 million property and the yield's 8%, with that's vacant, that you'd pay 8% on the market rent. If there's a 3-year lease, you'd probably pay 1.06 mil, which would be a 7.5 net yield. There's about a 3% inverse relationship. The longer the lease, the more value it adds to your property. So let's fast forward to a 10-year lease. You would be paying probably 1.34 million for that, which is a 34% increase in value. So it's like a compounding 3%. And that yield would be only 5.95. So that's the advantage. And a lot of, I guess, active investors do this. They'll go find a vacant property, find someone who will sign a 10-year lease, and then they increase the value by 34% minus incentives. So it's a very good strategy. And that's why things like childcare sell at tight yields. Like if you've got a 15-year lease, you might be buying that at a 5% yield. So 56% difference in price if you use that same inverse relationship. So it's very important to get a long lease for a valuer, but don't lock yourself into a low rent for a long period of time either, because long leases can trap you as well. So, right now, industrial properties, you don't want a 10-year lease because you're going to fall behind the market for 10 years. So very interesting setup. But both those first two strategies just require better management. So, you've got to do cosmetic renovations, signage, opportunities. Like, if you've got a shopping center, like maybe do a website for them. Like you've got to be active. You've got to show you're doing something rather than just asking for money. And that really helps those conversations on those first two. So
and a lot of that is just time, energy, and effort, right? Like, there's not a huge capital outlay. It's just about being sensible and smart and spending your time on that.
Exactly. Yeah. And I've just, this is a weekly event type of thing. So these value adds work. You don't only want to think about value adds, because that's another trap. If you start just going, I need to buy anything at a low yield just because I can see some upside, then you just, you've been a bit one-sided, and most good investors look at the whole picture rather than one part of the picture.
So how else can you accelerate or gain upside on your portfolio?
So improving tenancy mix is the other one. So this is probably more reserved for your larger investors. So, I'd probably say over 3 million in purchase price. You might have a multi-tenant investment. Good example is like we're looking at a deal for a client. It's like a little homemaker center, and it's got non-branded tenants in there, like a gym that we have, like a local gym, a grocer, local grocer. Like it's got all these sort of B grade tenants in it. The client's going to go in there. We already know that it's a great location. It's going to really attract national businesses, but the previous owner self-managed the deal, didn't put much effort into attracting the right tenants. So there's a mishmash of tenants. So it doesn't look good day one, but if we can attract those big branded tenants, they'll all start flowing in, and there's a significant uplift there because you're going to sell it or revalue it at a lower yield because the perceived risk of a ASX listed tenant is lower than a local gym. So people will pay more for the same rent. So that's again, you're not building anything. You're just basically changing the security in the asset. And that's the biggest difference with residential to commercial with value adds. If you increase the security, you increase the value. Like, outside of like residential, like you don't really care who the tenant is, like you're not going to pay 30% more if the tenant's a doctor versus a mechanic. Like it doesn't matter. Like the rent is the rent. And that's one of the differences. Renovating properties, sort of, I've always worked out you normally get 2 to 3 times the money you spend. So if you refurbish, gut properties out, it's got kind of like a lot of benefits that you you wouldn't really think of at the start. Like if you'll attract a better tenant if you prepare your vacant property better. Like you've got a nice white palette, brand new windows, all that kind of stuff. It's going to be better than leaving stickers and, blue and black paint from the last tenant. Like, it's just going to attract a different level of tenant. You'll fill it faster. You might get more rent for it. So renovating is generally a pretty good play with your property, but always renovate for the tenant's benefit. It's tenant in mind is the key. Otherwise, you're going to blow your dough. The next few value adds are all to do with increasing the net lettable area and increasing the value of that lettable area too. So developing is the obvious one. So one thing we're seeing people do a lot in this market is develop by, using a DA to sort of put some extra footprint on the property. So you might have some free land. Good thing with commercial property, you can actually, sometimes there's no zero setbacks on the building and the boundary. So you can fill out any little gap depending on the council, maximising the floor space. We're looking at a deal for a client today. It would have cost, it was a 5,000 square metre add-on to a property. So it's a larger deal again, but you'd probably allow for 1,800 a square metre to build that. So, what's that? 9 million. And then the end value of that at a 6% cap rate was about 14. So pretty good profit margin. We haven't, it's high level. There's obviously a little holding costs and stuff like that you'll need to factor in, but building can be very lucrative if you get the right asset and you're not paying overs for it. So it goes back to the buying and the location, of course. But something that a lot of people don't know, but it's starting to come up more, is change of use. So if you go into those grey fringe areas, and what a grey fringe area is, residential near existing commercial. So the classic one is houses near industrial sites. That could sort of swing either way if you apply for a change of use to council, and depending on what the demands are of that local community, that could significantly change the value. That's a low percentage play. It's something that a lot of investors dream to do and not many will ever pull off. But if you are on a fringe area, just always think about that. Like, if you're at that boundary and you can see a house, or you can see a high rise, or you can see a shed, those can swing either direction depending on the governments at the time. So yeah, we're seeing a bit of that in Alexandria, as we've mentioned. Strata titling. So this is something we're getting pretty big with at the moment. So I love strata titling because it's like you get developer margins without developing. So you're basically splitting up a big pie into little pieces. A good example was in Brisbane. My client purchased an asset for 4.5 mil 7 months ago, and he ended up strata titling it and selling it for 5.96 mil. 5.96, yes. So pretty good margin. He's had to pay stamp duty on that and then selling agent costs. So there's probably about $500,000 in those costs, or about 400 all up, but pretty big profit margin for doing very little other than...
What did he buy it and what did he sell at?
4.5 and sold at 5.96.
Okay.
Did you
have to spend a lot of money in terms of like electrical and mechanical and all that sort of stuff?
Circa 50,000 all up.
At all.
So not much. And it's because you're not changing the walls of the walls. They're fireproofed. That existing infrastructure in there. Like, it was really just a lot of their money they spend on just tidying up gardens and stuff like that. And obviously their town planning and council paperwork had their fees, but very low impact scenario. And we identified that as a really good upside with that deal, because I always think about the end product. We've got so many people desperate for small warehouses, and there's someone selling 7 of them in a row. Like, why didn't the owner think to sell them 7 times? There's a missed opportunity.
Yeah. All right.
And the reason the value goes up is you're selling to a more competitive part of the market. So you're buying at 4.5, less buyers, selling at, under $1 million, lots of buyers. So yeah, sharper yield.
So there's some great ways to sort of further the upside. But there's some sort of more left of field thing, I guess, is the sort of 7th step or stage or strategy, is not something that most people would think about, right? In terms of getting greater upside.
Yeah, so reducing costs or creating new incomes via Solar panels, it's the big one. Every time the power bills go up, this increases the margin on this type of development. It's not a development, it's really, well, there's two ways to do it. So number one is you just pay for the solar panels yourself, and then you deal direct with the tenants. So you've got to then try get them to pay you instead of the mains. A little bit tricky, and it's probably more suitable if you've got a bunch of gross leases where you're paying the outgoings. So gross leases probably make it more of a business case for you to buy the solar panels, own them yourself, and do with that. But if you've got net leases where the tenants are paying everything, you are economically better off to lease your roof out to a third-party solar panel company, and they'll pay you a percentage of their profit. So, basically it works out. They get their return on money, in about 4 years on the asset, but then they'll pay a lease. And normally the lease is 10 years. And it's like a standard lease, so it's another income. So you can capitalize that income against the valuation on your property. So, if you have a $5,000 new income at 6%, that's 83 grand in new income or new equity. Plus you're getting a 5 grand per annum extra income. The larger the asset, the more power the tenant uses, the more solar panels and the more income you'll get from that third-party provider. We've set up a company. It's called Rethink Renewables that does exactly this.
Have you actually set up a company now that does this? Because we spoke about this a year ago, and you were like, you weren't convinced, and you just hadn't really, you looked at it all, and you were still, knowing you, like I know you, you just had question marks all over it. So it sounds like you've actually nailed it now. You've worked out how to do it.
Yeah, it's tricky. So you've got a purchasing power agreement, which is not always accepted by the tenants because it's like they're getting locked into something. So there's not, and sometimes it goes longer than their lease, which doesn't. So you've got to deal with like break lease clauses. So there's a fair bit of risk for the business. The reason I think it's such a good solution is it just gives every single freehold property owner the chance to make more money for doing nothing. So you're effectively just getting a new lease. You're not paying for the solar panels. It's another third-party income, and the third-party income is the key point. That's why you can capitalize that rent at whatever the market rate is in that area. I'm doing it to all my properties, and we can't do it in WA for some reason, but we're looking into it. But yeah, East Coast stuff, it works quite well. And it's an extra income. It turns the property into green energy, which is good for the tenants, the image of their business as well, like depending on how eco-friendly they want to look. But it saves them power, like significant amounts too. Initially they might only save 10 or 20% on the mains, but it doesn't increase at the same level. So they might be paying like half the cost of mains next year. So it's a real win-win-win. The owner wins because they've got a new income, new equity. The tenant wins because their power is cheaper. And then, obviously it's just no one loses in this scenario. And then you're not having to deal with
the main winner. Increases. The main winner, our green friends would say, is that the environment is the winner on the win-win-win.
Yeah, exactly. And it takes off significant burden on the big industrial sheds in the city. Think about it, that's a commodity. That's why I've set this company up. I think it's an absolute waste to have all this massive space which is in the middle of the city not used. Instead they're putting solar panels out in the desert, and they've got to ship it through, and you lose all that power through basically friction with the wires. And you've got it in the city, you should utilize it, and the tenants will directly benefit rather than having to sell it back to the mains, because that doesn't work anymore. That the ratios, the amount they'll pay per kilowatt, it doesn't stack. So you have to make your money through the tenant.
So you got to make it and use it. So keep it localized and I guess sovereign, right, to the asset, rather than being a contributor to a wholesale network.
That's right. And obviously storage and stuff like that's not great at the moment. So it's another good thing, because most commercial tenants work in daylight hours as well. So, you're not having to store it. It's just direct. And it obviously works better in places like Queensland compared to Tassie. But we're a very sunny, lucky country. So every commercial investor.
Are you channeling your inner engineer with this one, Scott?
Well, I'm not the expert though. I'm working with a guy, and we'll get him on the podcast one day.
Yeah, I
He's a
can learn
genius
about
with this
this.
stuff.
But it makes sense,
Yeah,
this is about not only maximizing cash flow, it's about manufacturing equity, right? You want to be doing both.
yeah,
And for those commercial investors who are leveraged and are not getting, the positive or the cash flow they were once getting, there's other ways to squeeze more juice out of the lemon, while also increasing its value. It's quite a long podcast, Scott. We've been chatting for hours, it feels like, but mate, I always enjoy getting together.
yeah. You too. It's been a little while. We obviously pre-recorded a couple of those other ones before I went overseas, but yeah, no, it's good to catch up back in the country for our next one, and I'll get my wife onto the podcast if you'll have her. So we'll
No,
quiz her on
absolutely.
property management.
I actually want to. I don't think we've met before. It'd be good to see the actual brains trust of that outfit rather than just chatting you all the time. The person
Keeps
that
the glue
probably,
together.
yeah.
Yeah, I think we had her
Oh, we
during
did
the
once, didn't
COVID
we?
period.
Yeah,
It would have been like in COVID, like because
it
we're
was
all
during COVID.
locked up somewhere.
Yeah, yeah. Well, things have moved on. I very, very rarely use the word COVID now. Everyone's like not even talking about post-COVID conditions anymore. It's just the way it is.
Yeah,
Which
distant
is
memory, isn't it?
yeah, it is. It's funny how it plays out. But anyway, Scott O'Neill, well, thanks for your time. Good to see you. Look forward to catching up again, and we'll cover stuff off. Remember, any questions at all? And we get heaps coming through. Where's the best way to contact you and your crew, mate? If you've got questions, or if they want to send any feedback to us, or just to maybe find some time and have a chat with you or the people inside your organization.
Just Google Rethink Investing and go to the Let's Talk section. I think Googling's always the easiest rather than remembering emails. But yeah, that'll just directly go back to us, rethinkinvesting.com.au. And yeah, keen on any new topics as well for this podcast as well. Any questions, yeah, just direct them through. And yeah, we'll either answer them privately or on this podcast. So
Yeah, nice one.
keen to chat.
Look forward to it. Scott O'Neill, Managing Director of Rethink Investing, mate. Thanks for your time. We'll see you again next time.
Thanks, Phil.
Nice one. Thanks for tuning in, everyone. Remember to go and have a look at rethinkinvesting.com.au. Any questions there, happy to answer them live. That's what we like to do. And we'll do some more stuff moving forward as well, and do some big Q&A sessions. Thanks for tuning in. See you next time. Until then, bye-bye.